Good day, everyone. My name is Marc-Andre Pelletier. I'm President and CEO of Bonterra Resources Incorporated. Bonterra is a junior exploration company with a large portfolio in Quebec. What makes Bonterra apart is our infrastructures. We have mill, we have camps, core shacks. And since I joined the company 5 months ago, we've been focusing on this company strategy, and basically our strategy is to advance our project from exploration to development to production restart. And for that purpose, the company initiated a PEA on the Barry open pit project 4 months ago, and we just published the PEA 2 weeks ago, and we're quite excited about it.
Indeed, you did. Well, it was good to see you again, Marc-Andre. I think last time out, you were relatively new to the company, but you were very quick to come up with a strategy which you felt could help save the company and, more importantly, kind of see it through these kind of difficult economic times that everyone is going through. So the PEA is the first step in, trying to understand how you release value from the open pit at Barry. So did the numbers tell you what you hoped they would? Is it better? Is it worse? I mean, what did you feel when you put that out?
Yeah, it's as per expected, to be honest. We knew that the majority of our resources at the Barry open pit were in the measured category, which means a higher confidence level. And when you compare the resource to what is in the mining plan for the PEA, we basically had a conversion of 90% of the resource. So 90% of the resource remains in the mine plan, which is very high for the mining industry.
Right, but remind us what you've got there, because it's not big. It's like 150,000 ounces, right? So, and I get that it's low capex, but it will generate cash for you, and that does a job for you. So, I mean, apart from not needing to get into the market and raise it, but what else does it do for you, and why take this small step before going underground?
Yeah, the last time we talked, Matthew, I mentioned the word bootstrap approach. So start small and grow the business, and that's Bonterra's strategy. And the Barry open pit bothered very well with that strategy because, of course, it's a small project. 158,000 ounces, 5 years life of mine. So it's about 30,000 ounces a year. Modest investment. We're talking about $21 million for initial capital requirement. But really, it will generate some cash flow for the company. And the intention is to invest the cash flow into the Barry underground, which contains 1.2 million ounces of resources. So really, the Barry open pit is just it's a baby step for Bonterra, but it's a big step as we're going to production restart. We will have to gain our credibility as producer, which I'm very confident we will. But our focus, is moving to the underground resources. We actually have 2 diamond drills on the Barry underground deposit, and we initiated an infill diamond drill program already.
Right, but the underground bit, you've put out some headlines which are super high grade. We've seen 69, 70 grams over 2 meters and 305 grams over half a meter, and so the underground bit is kind of showing the grades and the veining that you're going to want to see. But I just want to stick with the open pit bit. 5 years, 30,000 ounces a year on average it's okay. What sort of cash is that going to throw off, and exactly what do you do with that cash? Because there's with all of these small open pits, you can extend them life of mine somewhat. Are you going to be able to do that here, do you think, with a bit more infill drilling, or is it really just 5 years?
We have done some exploration drilling on the east-northeast side of the pit. And we have done some. There's actually 3 pits. So there's a big one and 2 small ones. They're kind of satellite pits, and we've done some drilling between those pits just to see if there's any gaps we could close there. So that drilling has been completed as we speak. And as we are going to the PFS level, we are going to look to see if there's if we could make those bit bigger or group them together or extend them on the east-northeast extension. So we will proceed we will do that exercise as part of the PFS.
Okay, that's what I was looking. That's what I meant by the kind of infill drilling between connecting those three pits up. So you'll let us know. But so how much money are you allocating to that work, that drilling?
The drilling it was a very small campaign, Matthew. We talk about 12,000 meters. It was just finished last week, so it's already done. So we are waiting for assay to come back, and then we'll, interpretation, remodel, and then you push enter, and then you see what your new resource is, and it's going to be look at the PFS.
Okay, so assays will come back. You'll let us know, obviously, what that looks like, and maybe that extends or increases the number of ounces that you're looking at there and extends the life of mine, and therefore the contribution, right? But the PEA, just to be clear, is just on the Barry open pit component. It doesn't take into account anything of the underground. Is that right?
Correct. So when you look at the Barry deposit, the deposit goes down to 650 meters deep, and the open pit resource goes down 100. So it's only the first 100 meters of the deposit that is part of the PEA. What's interesting at Barry underground, from 100 meters down to 650, I mean, it contains 1.2 million ounces. That is a lot of gold. And honestly, it's a fairly shallow ore body. It's 650 meters in the Abitibi region. It's not a deep mine at all. So more I look at Barry, more I see potential to add more ounces underground.
Okay, but here's the bit that people are going to want to get at, which is, okay, we understand that you're mining the open pit and processing it through your own mill, your own infrastructure, and we talked last time about increasing from 800 to 1,200 tons per day. That's happened, I assume. Is that?
Yes,
it has. Okay,
all paid for. Those investments will be part of the restart of the open pit.
Okay, so you still got to raise that capital. We'll come back to that in a second. But the open pit, people understand it's a kind of what do we call it? We call it an ATM, a cash machine for you guys to go after what you're really after, which is the 1.2 million ounces and maybe more of the underground component, right? But you've got have any studies happened on the underground component yet? Historical or otherwise? No. Okay.
But we do have an exploration ramp in place, underground working, that goes down to about 100 meters deep elevation. However, the definition drilling that I just mentioned is all surface drilling. So right. It's not done in the ground. And it's because we have a much better access to the deposit from surface. It's much easier. And it's also cheaper. Right.
Okay. Because, if you look at the AISC on the open pit, it's just over $1,000 US, which is good. That's fine. But I think if you're saying that the real prize is the underground component, and you're trying to do everything you can to make sure it's not a dilutory, process for your shareholders or the company and the shareholders, for the underground bit, people want to know what the economics could look like for that component relatively soon. So is there a kind of process that is going to start, or what's the timing on a process it could start to help understand the economics of the underground?
So I mean, going underground makes sense, and our business is very simple, Matthew. You always have to feed your mill with the best ore available. For now, for Bonterra, it's the Barry open pit. We need to develop the underground. The grade's going to be twice higher, so the production is going to be twice higher. The 30,000 ounces become the 60,000 ounces. We have to do our homework. By homework, I mean we have to do the drilling. We need to understand that deposit better. the open pit will allow us to understand the deposit better. And I think that knowledge would be very useful for the underground portion of the deposit. In terms of timeline, I mean, we're working on the detail, but when I look at the PEA, in my mind, we need to bring the Barry underground in production. When I say production, restart, and ramp up, I would like to bring that deposit in 3 years, so 2026. So just before the pit, year 3, the pit will keep going. However, the underground portion of mill feed will increase and to eventually up to 1,200 tons a day. And at that time, Bonterra will be a 60,000 ounces producer. Cash flow will increase. Okay, mining underground is more expensive, so there's good chance, underground development is expensive. The AISC will probably be higher. However, production will double, so we are going to generate more money. And the intention is to continue to develop the Barry underground, and that money will also fund the Gladiator deposit, which is another 1.4 million ounces in the resource.
Right. And for Gladiator, in fact, let me not get distracted. Okay, I want to come back to the open pit. You're going to need to fund $22 million. What type of money do you think you're going to be able to bring in? Given that you think that this thing could start throwing off cash relatively quickly, it's not a big risk profile, I suspect. But can you get 100% debt? The initial capital costs?
Yeah, good question, Matthew. Our approach now would be a mix of equity and debt. That'd be the preferred option. We started to look at our options. There's more appetite on the gold. I think it's something you probably notice it at the PDAC, but lots of enthusiasm about gold, and I think for our industry, it's very good when people start looking at a company like Bonterra and say, "Oh, maybe you're going to need money. Maybe we can do something." So we are in discussion with some parties already at very early stage, but equity will be the preferred option, of course, but a mix of debt and equity would probably be more realistic in our case.
Okay, which is kind of conventional, 60-40, kind of that sort of level. Because I'm thinking, if you're looking at 145,000 ounces and 95% recovery, you're looking at today's prices, you're probably clearing 750. That kind of level, yeah. Maybe a little bit less, yeah. Mm-hmm. The expectation, so it's a good chunk of change, but you'd still need to kind of bring it. So are you saying you'd want to put some equity in there, or do you think you'd have to put some equity in there?
We will. We would like to.
You'd like to. Okay.
Yeah, we would like to. It's for a company.
If you could do 100% debt, would you do 100% debt? What you're saying is, no, we don't want to do 100% debt. We don't want that burden, because I don't know. They might take a lien over your asset or your equipment or your infrastructure. So that's not a very comfortable position to be in. I don't know what how they prefer, what security they will need if it was 100% debt versus, well, actually, if we put some equity in, it's a much better mix for us in terms of those securities, etc. I'm intrigued by the thinking.
Yeah, I think for Bonterra, I think we need to come up with the best deal for the company. So I think we need to look at all the options and which partners do you want to bring in, and how do they want to do it? So we need to talk to those people. We need the PEA is a great tool. Now we have numbers. We can talk about real things, and basically for us, it's very important to have discussions with our potential partners and find the best deal for the company.
Right, and obviously you've got Waterton.
And the shareholder.
But you've also got Waterton in the background, haven't you?
Excuse me?
You've got Waterton in the background as well, haven't you?
Yeah.
Yeah. Are they part of the solution, or?
I mean, I had the chance to meet Chuck Davison a couple of weeks ago, and honestly, is a very strong supporter of Bonterra, a very strong believer. In a company like Bonterra, when you look at the market now, all the volatility, I think it's very important for a company like Bonterra to have a partner and a strong supporter like Wexford. So I think it's a big asset, to be honest. And very important for us to continue our strategy and to do what we said we're going to do, and that's where our focus is.
Sorry, you got Wexford. Sorry, I think I said Waterton. Is it Wexford?
Wexford.
Apologies. Sorry, getting my wires. It's what I meant, not what I said. Okay.
You're gonna have to apologize to Chuck.
Apologize, Chuck. I apologize. Got carried away there. I'm dealing with Waterton or something else. That's where my head's gone. Right. So let's look at. And I just want to check one more thing before we leave the open pit thing. So the PEA was on the main open pit, or did it include the 2 satellite pits as well?
The 2 small pits as well. But
perfect.
We're talking about 10,000 ounces in the small pits and 140 in the big ones. So.
Okay, gotcha.
One thing, Matthew, is the total capital, the total investment in the 5 years, so initial and ASIC, we're talking about 50 million, okay? But 30 of that 50 million, so 60% will benefit our other project with shared infrastructures. And that's important because we could have done things a bit differently, probably a bit cheaper. But with the vision, to grow the business, we have made decision to spend the money wisely for the future of the company and not just solely for the baggy open pit. The tailings management area is the best example. $20 million will be invested. We probably could have done the project much cheaper just for the pit, but we want to do it right the first time. And we know we got one underground deposit coming up in 3-5 years, and it's worth to spend all that money now for the future. So that's very important to say.
Yeah, well, the other thing that's important to say is like you built 4 mines, right? So you know what you're talking about. So people need to listen. But explain what that means in terms of you could have done it cheaper now for a kind of quick short-term win versus doing it right for the long-term success of the company. Can you explain that to me?
It's all about footprint, Matthew. So we could have done a smaller footprint that could potentially be expanded, but at a higher cost. We made the decision to establish the maximal footprint on day one, and we will eventually raise the dams to get higher capacity. The 20 million, if you do the math, the 20 million investment Canadian will give us about 3 million tons of capacity. The pit is 2 million. So we gain an extra million. We figure for probably another 20 million, we probably can gain another 5 million tons. And that's the benefit of spending that 20 million upfront to gain 3 million tons capacity. But to get an additional 5, it would cost about the same amount. So that's the whole logic, to pay now and save later. That's really what we're doing. But it's important for us to do the right things because we have that long-term vision.
Do you feel, and I'm asking this as a mine builder, 4 months, right? You know what you're doing. Do you not feel in moments like this, whether the markets are like this or generally if you're getting feedback from retail investors who don't know how to build mines, you would rather be in a private entity? Because that's a very short conversation. We've got to do this the right way because it's in terms of in terms of total returns on investment, this makes the most sense. Are you sort of frustrated by the kind of people's view or valuation of your company in the market at the moment? I know you're only 5 months in, but have you got a view on that?
So I mean, when you, I'm honestly, I believe we are undervalued. I mean, before the market correction a couple of weeks ago, we're still undervalued. When you look at Bonterra, Matthew, you look at our mill, our TMA, our camps, that's basically our market cap. So you're getting 3 million ounces almost for free. But honestly, I think, my experience as an operator is when you do the right things and you meet the expectation and you move your strategy ahead, eventually you will get rewarded. In my mind, there's no doubt. I'm very confident that we're doing the right things. We're following the right path. And it's a matter of time, that the market will recognize the value that we.
I think they will when you kind of get into production, and and albeit small, 30,000 ounces, maybe moving up to 60,000 within 3 years. It's all kind of good stuff, but it's all kind of small stuff too as well. So it's the kind of cost of the money up front, the 21, 22 million bucks that you're going to need up front. And I know there's a sustaining number in there too, but you'll cover that from production, presumably. The capital markets are saying to you, okay, you're doing things the right way, but in terms of the reward that you're going to be allocated in terms of share price, you're not going to get that immediately. So what would you say to existing shareholders? Look, just come along for the ride. We're definitely going to be able to be, one, less dilutive, or hopefully once post capital cost raise, non-dilutive, and we can build something meaningful here. I mean, what's the ambition about where this can go? 30,000, 60,000 ounces? Can it be more?
I believe once we reach the 60,000 ounces a day, then that's when Gladiator will come online. And the vision has been, and that's part of the mill upgrade at 2,400 tons a day. We're working in the permitting for that. I mean, 1,200 tons per day from Barry Underground and 1,200 tons per day from Gladiator. And how many ounces? We're talking over 100,000 ounces, more likely 120, 130,000 ounces a year. And when you talk about value, I mean, the PEA was done at $1,600 US, and maybe we're going to get a quicker reward in a higher gold price environment. I think we've been very conservative with the PEA. Definitively lots of upside in a higher gold price environment, and I'm sure the market will recognize that. There's not that many junior gold producer anymore, and they don't exist anymore. And for Bonterra to become the next one of the next one will definitively interest the market. I'm pretty sure.
Yeah, no, I buy that. I buy the 3 year and the 5 to 5 year vision too, because you've got it all laid out in front of you and you've got the infrastructure in place, which can at least move to the next question, because I speak to a lot of CEOs with regards to the kind of the drilling component of exploration. It's getting meaningfully more expensive, per meter to drill. At the moment, it's getting meaningfully more expensive to actually put infrastructure in place. You're not immune to what's going on in the marketplace, but I guess you're kind of grateful for the infrastructure that is in place and the fact that you can kind of concentrate on the milling component, the producing of gold in the short term, rather than saying we need to spend all the money we raise on drilling at the moment. So you feel that your strategy has been validated by market conditions.
Yeah, we need to spend the money wisely. It's easy to spend money, but wisely it's a bit more difficult. I'm going to tell you a story, Matthew. I mean, when we opened up the Kena mine, we had 600,000 ounces, and we had a mine. We didn't see the end of the deposit. The deposit remains open at depth, and we knew that eventually, as we get deeper, we're going to increase the resource. The same logic for Barry. I mean, I would like to have 500,000 ounces in reserves to restart the production. So Do we need to diamond drill the entire 1.2 million ounces to find 500,000? Probably not. But again, the bootstrap, I mean, let's start the mine with 500,000, start slowly, ramp up, increase the production, find more gold below 650 meters depth. I mean, once we get there. So that matched perfectly with our vision.
Okay, so I've got to come back to then, given I have for myself identified the capital cost component as the only thing there may be some concern around, which is the kind of the ability to get that in a market like this. You can go and speak to Wexford and you can go and speak to the marketplace. Do you feel that you can get that done in a timely fashion? In fact, do you even want to even think about raising that money as the markets stand?
Yeah. One thing that the PEA allowed us to do now is to make our institution in Quebec, like the Caisse de Dépôt, IQ, FTQ. When you talk with those institutions, the first thing they ask is, do you have a 43-101 report? Which we did not, now we do. So, and we've been in discussion with those institutions already. So really the PAs, will allowed us to actually have access to more institutional investors.
But will they let you get away with a PFS in terms of, well, I think it's open pit, it's simple mining, simple processing, what we've got here. I think PFS will be enough to get this thing financed, or do you have to again go the next step and get a feasibility done?
Honestly, I agree. It's a very simple project. We have infrastructures, no major capital expense. Really, our focus for the PFS, we're going to do some fine tuning, but it's, in my mind, is we need to de-risk the project as much as possible. And we're going to use the PFS for that instance.
But do you do a feasibility study after that, is what I'm asking?
No, we don't. We don't have to.
So in terms of time frame, you just announced the PEA, and guess what? You got to keep going. So the PFS starts when and how long is it going to take? Because I say it feels like a very simple process, but how long does it take?
It's not that simple, but it's sometimes it's challenging working with the consultants. But we started the PFS already, and we're hoping to get the whole process done before the end of this year. Okay, that's our target. So it's going to be a very busy summer, Matthew.
Sounds like. Well, that's it's exciting. Thanks for coming on the show. Appreciate your time as always. I know you've been running around and you're busy at the moment, but I was just so intrigued to see how the new strategy is working out, what you're doing and seeing. It sounds like it's still on track. PEA is as expected, and PFS, if it's by the end of this year, you will presumably be having those conversations around how this thing gets financed. So appreciate your time today. Stay in touch, okay?
Yeah, sure. Stay tuned.
We will. Oh, so I've got one more question, and this was sent in by Goldpan on ca.ca, which is around. Have you had any? You mentioned this a little bit, but have you had site visits by any of the analysts in terms of getting coverage in place for you guys? Yes,
that was actually part of the PDAC a couple of weeks ago.
Okay.
Sometimes it's you're starting to get a bit more interest, and we were able to book a site visit with 12 investors. There was a one-day trip. We went to each site and explained basically the strategy, and visited the mill, the camps, look at the core. We actually went into the Baggy open pit, the past, the past operation of the pit. And so what we're starting to see is more interest. I think that the PE is really just the start of it, but I can see that it's going to snowball as more investors will be going back to gold.
Okay. So do you think, I mean, are you going to get more coverage from some of these analysts, and what do you think? What are their kind of questions? What are their kind of takeaways here? Do they agree with your strategy? First of all,
it's a simple story, Matthew. Our job is to keep the story simple as much as possible, so everybody can understand it. So far, we've been followed by Cormark Securities, and we're hoping to get more in the next few months. So, I mean, stay tuned.
Okay.
You're going to be more interest as we keep delivering on what we said we're going to do. So.
I'm all ears, Marc-Andre. Well, thanks for your time. We'll speak to you again soon. Okay.
Thank you for your interest, Bonterra.